Section 7.4, other methods of depreciation. We have 3 learning objectives. You need to be able to calculate depreciation expense using the declining balance depreciation method. You need to be able to calculate depreciation expense using the units of production method. And then you need to be able to calculate and record depletion of a natural resource. So any method of depreciation that records greater depreciation expense in the early years and then less depreciation expense in the later years is called accelerated depreciation. Remember, before we were doing straight line depreciation where it was the same amount each year for a full year. Okay? The declining balance method of depreciation is a type of accelerated depreciation that multiplies the book value of an asset by a constant depreciation rate to determine annual depreciation. Declining balance rate that is twice the straight line rate is called the double declining balance method of depreciation. Okay, so what we're doing here is we're going to take estimated depreciation expense 100%. We're going to divide that by the years of estimated useful life. That would give us straight line 20% depreciation. Now, we're going to do double declining, so we're simply going to take that 20% times 2 to get our double declining balance rate of depreciation. So here they've put it into a table for us. We see that we have an automobile. The original cost was $35,000, estimated salvage value is $3,000, useful life is 5 years. So we figured out this rate to be 40%, and that was from the previous slides. So in that first year, we're going to take $35,000, the beginning book value, times 40%. That first year, it's going to depreciate $14,000 to give us an ending book value of 21%. So then the second year, we would take that 21,000 times that 40%. That annual depreciation for the second year is going to be $8,400, okay? And to give us our ending book value. So we can see that as the years go on, the depreciation amount decreases. It's still going to be 40% each year, but that amount then will decrease, okay? Until that final year, it'll depreciate only this $1,536 to get us our ending book value of $3,000. Now, when we look for our total depreciation, it's still going to be $32,000. And that we would figure out the same way, $35,000 minus $3,000, that salvage value. So we're estimating it would depreciate $32,000, which is what we get here for our total. Okay, units of production method of depreciation. So here again, we're looking at another vehicle. This time it's going to be a van. We have our original cost, our salvage value, and this time for our useful life, we have miles. So that might be common when we see different type of equipment that depends on how much we use it, not as to how old it is. So here we see that we're assuming we're going to be using it for 120,000 miles. And then we're going to depreciate at 16 cents per mile. So what we're going to look at here is we're going to look at each year how many miles we drove. So in that first year, we see that we drove 22,600. We're going to multiply that 22,600 times 16 cents per mile to get the depreciation then for that year. And that's how we figured out the depreciation for each of those years. Okay, so here they're showing us we're going to take the original cost minus the salvage value to get the total depreciation expense. We would then take the depreciation expense divided by the useful life, and that's how they figured out that unit depreciation rate. Okay, calculating depreciation expense for income tax reporting. The U.S. Internal Revenue Service, the IRS, has published rules for most plant assets when calculating the amount of depreciation expense used in computing a business's federal income tax obligation. This depreciation method is called the Modified Accelerated Cost Recovery System. The Modified Accelerated Cost Recovery System is an accelerated depreciation method with described or prescribed periods for 9 classes of plant assets. So here they're showing us a table, depreciation rate for recovery period, and we have our years, 3-year, 5-year, 7-year, 10-year, 15-year, 20-year, and then they give us the rates for each of those. So here they give us an example. Excuse me, we have a computer. The original cost was $1,800. The property class is going to be a 5-year class. So here are those depreciation rates for each year. So for these to figure out our annual depreciation, we're simply going to take that depreciation rate for each year times the original cost. Okay, and we're always going to multiply it times the original cost. Here they're showing us the comparison of the depreciation method. So we've seen that we have the straight line. So this is what we did in our last section. Here we have our double declining, and then we have our MACRS. So they're just showing us when we look down the comparison of the total depreciation. I mean, if we look across here, the numbers are, pretty different. But when we look down at the bottom, when you see straight line and double declining, the total depreciation is the same. And here it's just a little bit more. So calculating depletion on natural resources. Depletion is going to be the decrease in the value of a plant asset because of the removal of natural resources. So an example that they give, our plant asset is a coal mine. We can see, we have lots of money into this coal mine. The beginning book value, the tons recovered, and then the annual depletion. So what this means is this is going to be the coal that is recovered out of that coal mine. The more coal that's recovered, then it's going to depreciate then in value. So here we have this depletion rate of $2.625. And so that's how we get our annual depletion and then our ending book value for that. So calculating depletion, how they got that information. We're going to take the original cost minus the salvage value to get the estimated value. Okay. Then we take that estimated value and we divide it by the tons of coal, the estimated tons of coal. That's what we're assuming that will be in that coal mine. And then this would give us our depletion rate. So here we have that $2.62 or 0.625 tons per ton. All right, number one, which depreciation method ignores the estimated salvage value? That would be a double declining, and the IRS one, MACRS. Number two, what is the basis for the units of production method of calculating depreciation? The amount of use the asset receives, measured in hours, units, weight, or volume. So what we looked at is we looked at that van, and so we looked at it in miles. A printer. Sometimes a printer will be in copies, how many copies it prints. So that would be like volume. Number three, describe the types of assets in the MACRS 5- and 7-year property classes. The 5-year property class includes cars, general purpose trucks, computers, manufacturing equipment, and office machinery. The 7-year property class includes office furniture and fixtures. And last question, number 4, how does a mining company calculate the amount of depletion for a year? They're going to take tons of material mined times the depletion rate, and that's going to equal the annual depletion expense. The depletion rate is going to be calculated by dividing the estimated total value of the mineral resource by the estimated number of tons of that mineral that will be recovered. That was the end of, oh, that shouldn't say 7.2, that should be 7.4, but that was the end of 7.4. You can now go on to the 7.4 work together.